Hello and welcome back. On last week's video, I walked through the forces shaping supply that were accelerated during the COVID pandemic and its aftermath. We see several themes worth mentioning as we look for attractive investment opportunities over the coming years. A new economic regime is taking shape after the COVID era accelerated pre-pandemic trends in the hyperspeed and geopolitical conflict like the US-China trade war and the war in Ukraine further fueled fragmentation. We expect the following years will see an evolution away of a long period of low, falling interest rates with more predictable, slow growth as the global economy became intertwined due to cheap labor. Moving forward, we expect a world shaped by supply, with higher inflation than the prior cycle and a reversal of globalization towards regionalization. While we certainly subscribe to the benefits that low-cost passive investments can offer a portfolio, a world shaped by supply may support more active positioning with a selective, more nimble approach to build more resilient portfolios. We expect shorter economic cycles with volatility in growth and financial markets. This will require investors to be patient, remain diversified, and adjust their strategy more frequently in response to new information and market shocks. Investing actively, despite the cost, can work well with a passive core allocation to look ahead and seize opportunities now. Remember, active management is not just owning wonderful companies or bonds, but also knowing what to avoid. This dynamic is already playing out in the increasing outperformance of active funds over the last several quarters, as you can see on the chart of U.S. mutual funds on the right. As an example, for stock investors, this should lead to an environment where active management can prove its value, uncovering opportunities in future secular leaders and mitigating risks. At Girard, we focus on building individual stock portfolios and selecting managers that focus on identifying companies with these sustainable competitive advantages and pricing power. These qualities help fend off the impact of inflation and offer more predictable earnings growth. We call these competitive advantages superpowers, and for example, many industries, such as pharma or autos, have moved towards outsourcing research and development to specialized niche players that have economies of scale and allow companies to focus on their core strengths. Often these long-term secular trends within industry, or moats, built around them are underappreciated by the market. In an environment where above-average inflation is likely, we prefer owning assets that provide pricing power. These kinds of assets are defensible because there are moats or barriers of entry around their businesses, whether due to regulatory, logistics, resource, or innovation advantages. Take an industry like cell towers. The cellular providers do not want to build all of their own antenna networks, especially with 5G requiring so many more towers, so they contract with tower companies to run space. This business has both pricing power, but also a great value equation. Adding a new antenna to a tower costs almost nothing, but the price charged is the same for every other client. This means high margins for these businesses. As companies aim to reduce capital expenditures, companies that lease equipment are also well positioned in another space where we see sustainable opportunities. It pays to own hard assets and equipment when the trend is moving away from large capital expenditures. Moving on to globalization and regionalization, we're going to have to build out new supply chains. Instead of having semiconductors made halfway around the world in an industrial park with component suppliers nearby, we're likely to see manufacturing hubs throughout the world, including the United States. Whereas the last decade's theme was just-in-time delivery, this new structure will need more inventory to account for geographic imbalances, more of a just-in-case philosophy. Logistics will be incredibly important in this world, so reliable computer networking, the ability to scan and track supplies, as well as warehousing to store items will proliferate. Turning to the theme of labor and energy scarcity, investors should be rewarded by focusing on software tools that simplify and streamline workflows, reducing the need for human intervention. You've probably become familiar recently with ChatGPT and the ability of artificial intelligence to leverage intelligence databases. Companies, for example, that build applications for customer support that move simple inquiries out of human hands will remain in high demand. From an energy resource perspective, look for companies that are repurposing byproducts into new energy sources, as well as traditional alternatives like solar, wind, and perhaps even nuclear. And finally, this follow the leader approach should emphasize companies with strong moats around their business in terms of regulatory, market share, and innovative product perspectives. This might mean companies that sell machines like gene sequencers, diagnostic tools, or even airplane parts, which require ongoing purchases of consumables and wearing out parts that carry very high margins. We hope you enjoyed these quarterly highlights, and the path of financial freedom and independence isn't always straight, but we're passionate about guiding you through the journey. Reach out to us at meetgerard.com or your advisor to learn more.